Hello and welcome to the 33rd Geopolitical Economy Hour, the show that examines the fast-changing political and geopolitical economy of our time. I'm Radhika Desai.
I'm Ben Norton, sitting in today.
And as you know, Ben runs Geopolitical Economy Report that hosts us. Also working behind the scenes to bring you our show every fortnight are our videographer, Paul Graham, and our transcriber, Zach Weiser. CBDCs, central bank digital currencies, the brave new world that awaits payments, money, and finance, the death of cash, the end of privacy. That's what we are going to discuss today. The well-known economic historian and dollar booster Barry Eichengreen calls central bank digital currencies the bad idea that won't go away. The American Bankers Association calls the digital dollar a costly solution in search of a non-existent problem. Many libertarians believe that they constitute the ultimate enhancement of state coercive and surveillance power. At the same time, most governments and central banks are investigating its possibilities. With us today to discuss what the fuss is all about is a great advocate of CBDCs. Professor Robert Hockett, Edward Cornell Professor at Cornell University, is an expert in financial law. He's an unusual guest for us. He is close to the top circles of the left in the Democratic Party, including important politicians such as Ro Khanna, Bernie Sanders, and the great AOC. He contributed to the Green New Deal and even wrote a book subtitled How to Learn to Love the Federal Reserve. Not attitudes we commonly go for on this show. At the same time, his plan for CBDCs in his recent The Citizen's Ledger, digitalizing our money, democratizing our finance, is centrally about what we have talked about on this show many times. In particular, it's about how to roll back financialization and lay the foundation for a productive and egalitarian economy. I mean, what's not to like? So do the vision and the politics really match? Well, let's find out. Welcome to a geopolitical economy hour that promises a real intellectual joust, Robert.
Thanks so much, Radhika. And hello, Ben. I've been following you guys for ages and maybe one of your number one fanboys. And so it's an absolute delight as well as an honor, of course, to be on with you guys.
Oh, great to have you, Robert. Thank you. So, Robert, anyone who wants to know more about CBDCs could do a lot worse than begin with your book, The Citizen's Ledger. It lays out very clearly and simply, in very simple prose, much of the thinking behind CBDCs and makes an excellent case for how they might be used to democratize money and finance. It lays bare the actual public origins of money, and it also makes the case for reorienting the economy away from financial speculation, away from predatory lending, and towards productive investment and greater equality. It was a very enjoyable read, so much so that I actually managed to read it over a sleepless long night flight from London to Shanghai recently. So thanks very much for it.
I was hoping that would help you fall asleep.
Sorry?
I was hoping that would help you fall asleep on the plane.
It didn't. Well, whatever. I was quite absorbed. But on reflection, I also wondered if it was not too enjoyable because it transported me to a social utopia. Afterwards, however, I realized that there is a whole history and politics to why the ideas presented in the Citizen's Ledger, many of which have been around for a long time, have not been implemented until now. And that today, the obstacles in their way, if we simply measure them by the sheer amount of predatory and speculative wealth that is being created in the United States today, are higher than ever. So it was for me like waking up from a pleasant dream to face a deeply distasteful reality. And on reflection, then I further wondered, I also wondered about the dream itself. Do we really need CBDCs to achieve our purposes? Is it not excessive, like using a steamroller to iron a handkerchief? So there are so many questions, but let us start with your dream. We will do the waking up a little later. Why don't you start us off, Robert, by laying out as briefly but as fully as you can what you're trying to do in this book?
Yeah, sure. Thanks so much. What a great setup. First off, I mean, methodologically speaking, the way I tend to approach questions like that addressed in the book is in a sort of a three-phased way, or sort of a three-part way. First, I ask about the merits of a possible proposal or a possible sort of change or institutional rearrangement or whatever. Like, is it worth doing if it, assuming that it's possible and feasible? Next, then I turn to whether it's sort of logistically or technologically feasible, right? Is it a heavy lift technologically, or is it something that's fairly straightforward and easy to do? And then finally, thirdly, I ask whether it's politically feasible, or at least close enough to politically feasible that it's worth giving a go, or worth advocating for. And as a part of that sort of feasibility inquiry, I sometimes also ask myself, might it be sort of achieved by stealth, as it were, or sort of incrementally, sort of bit by bit? Obviously, there's some sorts of changes that one might wish to make that can only be made wholesale, but there are other kinds of changes that one might wish to make that could sort of proceed gradually, sort of bit by bit. And so I asked myself about, when it came to this particular proposal in this particular book, I came up with, sort of what struck me as reasonable yeses to all three queries, right? In other words, are the merits justifying of the proposal? Second, logistically and technologically, is it feasible? And then finally, thirdly, politically, is it feasible, at least in some sort of incremental, by stealth sort of way? Those are the three queries that I sort of posed to myself and came up with a yes for in all cases. So to begin with the merits, it might be helpful to say something about what I'm looking at currency or money as in this particular proposal. You guys, anybody who's sort of sort of educated in the Marxian tradition knows that there are many aspects to money, so that it's always very possible, or quite possible, anytime two or more people are talking about money, that they're actually talking about different things. So the sort of working understanding of money that I'm operating with in the book is that a money is, quote, that which pays in a system of payments or a practice of payments, and two, that which counts in a system of value accounting. Now, note that that definition is free of any particular monetary medium. It's neutral as between, say, paper currencies or metallic currencies, or just what Marx dubbed back in the 1870s credit money. And I'm thinking of money in this particular context as a kind of credit money, but also as essentially a money of account, as Marx would also call it. So insofar as we're talking about central bank digital currencies here, I'm sort of less fixated on some particular currency like, say, Bitcoin or Ethereum. I'm only talking about the dollar, but I'm talking about digitizing the dollar in a particular way. So here's the way, and I'll do this fairly in abbreviated form so I don't sort of take up too much time. But basically, if you think about it, if you think about the way the Federal Reserve System is sort of set up and the sort of institutional arrangements of it, it is in one sense, at least, quite literally a central bank, in the sense that it's a bank between all the banks. It's a bank to the banks. So all of the private sector banks, which are really public entities in a sense, or sort of public-private entities, because of course our financial system is essentially a franchised system, the banks all have accounts with the Federal Reserve, right? They maintain accounts in the particular regional Fed banks that have jurisdiction over the regions in which they exist. And as you guys know, one of the principal ways in which the Fed itself conducts monetary policy is by simply crediting banks' Fed accounts when they want to sort of increase the money supply and get people spending more and, sort of juice the economy, as they say. And then by the same token, but in token, no pun intended, by the same token in reverse, they'll simply raise the interest that's offered on reserves, so-called IOR, or interest on reserves, when they're trying to tighten monetary policy. Now, this is a notoriously inefficient way of conducting monetary policy, essentially because it relies on middlemen whose primary motives are profit margins, right? They're not really that concerned with the macro economy or with the well-being of individuals. All they care about is how they can profit most. But when you ask yourselves, well, why do we have that system? It seems to me the answer is political. It's not a matter of the merits. So what I got to thinking about was, well, why isn't it the case that every individual, every citizen and business and legal resident of the country has its own account with the Fed, instead of relying on the medium of the banks, right? Why can't I have an account at the Fed? Why can't everybody in the US have an account at the Fed? And it occurred to me that if we could do that, if we did have that, then monetary policy would be much more effective, for one thing, right? Because you could quite immediately affect purchasing power and affect, the so-called wealth effect, and induce people into spending more or to saving more simply by offering interest on every individual's Fed accounts and raising or lowering the rate, maybe sometimes impounding funds if you have to during inflationary crises, in the way that Keynes suggested in How to Pay for the War back in 1940. That would be a wonderful way to do things, it seemed to me. Now, in the course of thinking about all of this, I found out, or I learned back in around 2017, 2018, that the Treasury Department of the US, which is nominally distinct from the Fed, since we artificially distinguish between monetary and fiscal policy, actually already offers something like this. And this comes as a great surprise to lots of people, right? But it's just the case. Anybody in the US, any citizen in any business, can open an account with the US Treasury. It's called Treasury Direct, all one word, but with the D capitalized in the middle. And if any of your listeners or viewers want to find out more about it, just Google Treasury Direct and you'll go right to the website. And the idea is basically anybody can open an account through which to purchase and redeem US Treasury securities. And all that you need in order to be able to do this is also a separate bank account, right? And hence a way of sort of receiving the cash when you redeem your treasuries and an account out of which to pay for those treasuries. But if you think about this sort of technologically or logistically, there's no reason to require that additional account. There's no reason you couldn't allow people to maintain money or value in their Treasury Direct accounts themselves. Now, when the pandemic broke out in the US and in the early 2020, basically, and everybody was sort of beginning to wring their hands about how to get money out to the public, right? And will the paper checks that are sent out to people themselves be vectors of the virus? And might people's addresses not be updated? Might there be sort of inefficiencies when it comes to sort of just sending money out as we did in 2020? And it occurred to me, well, this would be an excellent time to make a specific proposal to upgrade the Treasury Direct system so that everybody in the country could open up a Treasury Direct account on their smart devices or smartphones and receive payments in their TDAs. So at that point, I phoned up there's a relatively new U.S. agency called U.S. Digital Service. This was a darling of Kamala Harris, interestingly enough, and was a darling of the Obama administration. They're the ones who put it into place. But USDS is a very efficient, sort of tightly run, small little federal agency responsible for technologically upgrading every sort of instrumentality that the U.S. government uses when upgrades seem to be called for. So I contacted them and I asked them, how feasible do you think it would be to convert Treasury Direct accounts into digital wallets accessible to everybody on their iPhones or smart devices? And USDS, to my amazement, said, oh, that's a piece of cake. We could do that within 3 months. Within a few months, in other words, everybody in the United States could have a bank account, so to speak, on their smart devices, operated through Treasury, through which Treasury could directly inject money into people's accounts, and on which the Treasury and Fed, working in tandem, could pay interest on those accounts as well. And that, of course, would then overnight take care of the problem with the unbanked, which, as you guys know, is pretty severe in the US. About 25% of Americans don't have any sort of ordinary banking services, whatever. But 95% of Americans have smart devices. So you could largely take care of the unbanked problem in a single go. You could make monetary policy much more efficacious, right? Much more immediate, because you could cut out the middleman. And in addition, you'd have everybody having now a savings platform in the form of their TDAs, everybody having a mode of peer-to-peer, P2P payments to one another, because Radhika and Ben, if you had accounts here in the US, I can make payments directly to you and you to me. Lots of small businesses, they're constantly grousing about the fact that they are charged a huge cut for using the electronic payment system with bank cards and the like, would now be freed of all of that skimming that's done by the financial intermediaries that don't have any reason to exist, and so forth. Finally, final point here when it comes to advantages that this would offer is that this would enable then the Fed and the Treasury together also to make credit money quickly and cheaply available for productive purposes, right? Essentially to help make infusions of money capital into small businesses that had interesting value-adding plans, ways of new ideas for production and producing and employing. In effect, you would again no longer be allowing the banks to hold productive investment hostage and to sort of redirect what could have been productive investment toward merely speculative investment, quote unquote, where people are simply betting on price movements in secondary financial markets and tertiary derivatives markets. So that, it seemed to me, meant, all right, the merits question, yes. The technological feasibility question, yes. What about the politics, the political feasibility? One quick remark here, because I know this is going to segue quickly into the waking up from the dream, is it occurred to me that if we were to start something like this with a limitation imposed, where we were to say, all right, nobody can hold more than $1,000 or $3,000 or $5,000 in their Treasury Direct wallets, then the larger banking institutions might not be quite as terrified because, of course, people, the sort of small fry investors or small fry savers, or the people who aren't very well-to-do, tend not to have accounts in those banks anyway. And so the argument I was thinking, this might be too clever by half, but the argument I was imagining I might be able to make to the banks in pushing this is to say, look, the primary constituents or constituencies for a plan like this are people who don't use your services yet anyway, because they simply don't have enough. But if this program or if this system were to enable them to start accumulating monies so that they actually weren't indigent any longer, then they might actually find themselves moving over to using your services as well. Because oftentimes, once somebody gets one bank account, it's not long before they start using other banks and their services as well. In other words, many people don't just stick with one bank if they have enough to put in a bank in the first place. So this could actually even redound to your benefit, bankers. Now, of course, I say that a little tongue-in-cheek because I don't really want to benefit them, and I would ultimately like to phase them out, basically just end them entirely, as the book, of course, suggests, meaning remove any limits from TDA accounts. But as a kind of camel's nose under the tent, so to speak, or as a kind of Trojan horse, so to speak, it seemed to me that there's at least some reason to think that that might happen. And I did manage to get a fair amount of congressional interest in this in both the House and the Senate from Democrats and Republicans alike. So I'll just sort of pause there, I guess, and say that's the sort of introductory spiel. I hope that kind of covers everything.
Yeah, these are very interesting ideas, and I like the analogy of the Trojan horse. I mean, because really, what I've referred to this as a kind of backdoor nationalization of the banks, because by offering a public option for people to have a retail CBDC account, it means that they would not have to be held hostage by the private banks. And it's especially important right now, considering that the Fed funds rate, the interest rate right now, is 5.33%. But the average private bank in the US only gives, on average, 0.4% on a savings account. And many deposits get even less, especially checking accounts get basically nothing. So there's this huge spread there where the banks are making so much more in the reserves that they hold in the Fed, because now the reserves they hold in the Fed, they get paid by the Fed. They get paid the 5.33% interest rate. So, in fact, what was interesting is the IMF published a report on CBDCs in 2023. And one of the things they pointed out, of course, the IMF often is very friendly to the commercial banks. And they pointed out that commercial banks were concerned. They wrote, CBDCs could lower bank profits if banks raise deposit interest rates to compete with CBDCs, or funding costs increase from a shift toward wholesale funding, then bank profits will decrease. So, of course, what we've actually seen, you mentioned the political feasibility of this. Well, it's not just getting people in Congress to support it, but it also, of course, the banks themselves on Wall Street, they're not going to support backdoor Trojan horse nationalization, because then they're going to potentially lose all of this customer base. I mean, you mentioned this potential idea of starting with maybe just 1,000 in a limit in the account or whatever. But Bloomberg has published multiple articles showing how Wall Street has actually been lobbying very aggressively against CBDCs, which is funny because, libertarians say we have to be against CBDCs, and they also claim to be against the banks, but this is yet another example of how libertarians are objectively on the same side as Wall Street and the big banks. So how do you deal, you mentioned trying to get some support from Congress, but how do you deal with the elephant in the room, which is Wall Street is absolutely going to be against this idea of retail CBDCs. And I think it's more likely that instead Wall Street would only allow maybe certain institutions, big companies, not individuals, not households, to have CBDC accounts.
Yeah, so a couple of things. I mean, the first thing is that when I sort of first started putting this thing out there, I was calling it the digital greenbacks plan, sort of as an homage to the first version of the dollar bill, which was actually called the greenback and was issued by the U.S. Treasury. There wasn't a Fed until 50 years later. But in any event, when I started putting out this digital greenbacks plan and idea, I also called it the Treasury dollar plan and so forth. We were in the midst of course, perceived a sort of existential crisis. And so people were much more willing to think about much more radical things than they are now that we're sort of nominally out of it. And so it seemed fairly feasible at that time. It also seemed fairly feasible at that time because, of course, the banks were once again sort of whipping boys in the general public because they were viewed as, in effect, taking advantage of the crisis, in effect, receiving all of the congressionally appropriated funds to conduct the various relief programs and so forth. And so I thought at that particular point, the politics might have been propitious enough to enable us to sort of strong arm the banks into conceding at least a kind of limited program with the $1,000 cap or $3,000 cap or whatever. And I think your query, Ben, is quite apt at the moment because we're not in that moment any longer. And so, of course, it's going to be harder politically. Moreover, I'm not helping the cause by actually using a phrase like Trojan horse in a public venue, which I'm doing right now. But I'm also sort of thinking, well, maybe the banks won't notice me anyway. Maybe I'm very Trojan. But in any event, that's a difficult one. And I don't know that there's any obvious answer other than to say, well, usually it takes some sort of national crisis or some sort of existential moment, like the time of the Great Depression in the US and in Canada, and of course, much of the world in the 1930s, or of course, the immediate aftermath of the 2008 crash, or of course, the COVID crash. On the other hand, if one takes a look at where American politics are right now, and if one takes a look at what the options are when it comes to, candidates, it's not, sort of unthinkable that we might have another existential crisis in another few years, right? We seem to be sort of accelerating the rate at which these things strike, right? And so people used to say, this is a once in a century event, and then this is a once in every 20 years event, and now we're down to this is a once every 10 or 8 year event. So, insofar as, we're sort of reaching the asymptote and the distances between each pair of increments is shrinking, we might be in that moment again very soon. And so if that's the case, or at least if that's not a complete pipe dream, it seems that it's worth kind of thinking about and mapping out the logistics in a detailed fashion so that we can just pull it right off the shelf and put it into place right away in the event of the next crisis. I sort of think of this also, you remember in the manifesto, with the immediate demands of the Communist Party that are laid out sort of toward the end of the manifesto. One of those immediate demands is just an immediate nationalization of the banking system. And this is a sort of a long-term, this is a long-standing idea as one of the sort of first moves that should be made in the event of a kind of revolutionary change. And I don't necessarily mean violently revolutionary change, but just revolutionary change in the sense that institutions are all sort of rearranged and tossed about. And this could be viewed as a way of doing that too, but simply using the most, the sort of the most up-to-date or state-of-the-art technology. One final point maybe to mention here, Ben, is it is interesting, right, isn't it, that a number of countries that aren't even quote-unquote communist countries have gone pretty far in this direction already. You guys are probably conversant with the e-krona program or project that Sweden began to institute almost 10 years ago now. And at this point, the e-krona is the preferred mode of payment, right? The preferred means of payment. And most people make payments via that e-krona system. The other kind of cool thing about the e-krona is that you can algorithmically program into the currency privacy protections of a kind that are, fairly difficult to guarantee under the current U.S. system of banking. Because even though we have bank secrecy laws and bank privacy laws, most of them are honored in the breach. And I'm sure, as anybody who's receiving adverts on a regular basis from companies offering competing products with the products that they've purchased using their bank accounts can attest, We don't have bank privacy at this point in the US, even if we nominally do. And so another advantage to a system like this is that you can indeed algorithmically program privacy into the transactions themselves in virtue of the fact that this particular form of currency is being used and these particular wallets are being used. And that in turn means, I think, that you might attract another sort of quarter to be, sort of attracted to this. And that is not the sort of cryptopians, as I call them, that is to say, the sort of libertarian fantasists, but just people who are, have reasonable expectations of privacy. I think a lot of people don't maybe realize just how compromised their privacy is right now and how much improved it could be if we sort of changed our payment system in the way that's advocated here.
Sure. I mean, these are all absolutely interesting and fascinating. So let me just begin our little segue, or continue rather the segue you've already made into waking up from the dream. So I guess one of my questions is, when you say that okay, you might you might try to persuade the existing private bankers to accept this with a kind of this argument that it's it will bring more customers to you in the end, because those who will start with their $1,000 account with the central bank will then graduate to having others. I mean, that itself suggests to me a slightly more jaundiced analogy, which is that, like how the relation between vaping and smoking. I mean, vaping was promoted as, safer version of smoking, etc. But then it introduces children to nicotine, and they become then a market for cigarettes and other tobacco products and so on. So I wonder whether this will not because that's how you intended, but this will be the consequence of suggesting this at a time when the political power of the very financial speculators who are supposed to be removed by this system is very great. They both have the major parties in their back. They have both the major parties in their back pockets. So in a certain sense, I think that if your plan were to be realized, it would take such a kind of extremely problematic form. And of course, by the way, I should say that I also read somewhere that the banks are even resisting a very low cap. Like if you said you have a cap of $1,000 or whatever, they have actually calculated how much money they would take away from deposits. Mm-hmm. And of course, particularly since the repeal of Glass-Steagall, with allowing commercial banks to speculate in the essentially to engage in the kind of speculation that was once reserved for the investment banks, what that means is that their deposits are part of the throwaway that they use in their speculation and so on. So that's one set of problems I wanted to raise, which is that they are not going to take any threat to their deposits very seriously. So then the question becomes, if it is realized, what kind of deformed way will it be realized in order to accommodate to these interests? And of course, if you want to realize it in the kind of utopian way you are suggesting, you actually need a revolution, not a revolution by stealth. There can never be revolutions by stealth. You can't creep revolutions onto people. You'd actually need to talk about a socialization of the means of production and the whole shebang. So that's one thing. The second thing is that, and I just want to make these 2 points for now. So the second thing is, the more I thought about it, I completely agree with you, of course, that, to replace the existing branch bank system came into existence because, you couldn't have one national bank sort of, knowing about the whole country. But there is one function, no matter how badly it's played today by the existing banking system, which is to say you have to have local presence in order to know. Is this development good? Is this factory a good idea? Is this a block of flats a good idea? Should we lend money for that, etc.? And that's not something a bunch of people sitting in Washington or New York or wherever it is you want to headquarter your wonderful central digital currency are going to know. So that function would have to continue to be played. So wouldn't it be a better idea, rather than have a central bank digital currencies, to actually have a system of community banks which are, dispersed and so on? Because wouldn't that be somewhat more in line with what a socialist economy would need, etc.? And just one final, sorry, since this is relevant here, I'll throw this in. You managed to write a whole book which talks about the removal of all these private interests without ever mentioning either the words, either mentioning the word capitalism, or for that matter, I don't think socialism as well. So in fact, the only time you seem to use the word capitalism, you put it in quotation marks. You don't use the category of capitalism. You use the category of commercial republic. Perhaps you might want to say something about these 3 points, please.
Absolutely, yeah. Let me start with the localized banking point, because that's of course exceedingly important. It's another one that's very near and dear to my heart. And in fact, not to plug another book, but my next book coming out within the next few weeks that I'll send you guys is called Spread the Fed. And the subtitle is Distributed Central Banking for Productive Monetary Policy. And this book stems from, and I won't go into too much detail, but it is relevant here, of course, because it's complementary, of course, to the program or policy idea that we're talking about right now. And it also is directly responsive to your observation, Radhika. So another thing that people often have now sort of forgotten, assuming that they ever even knew, is that the Federal Reserve System is called the Federal Reserve System for a reason, right? It's actually constituted by 12 regional banks. And those regional banks, when originally established in 1913, were basically meant to be regional development finance institutions, right? The original design, and this is quite fascinating too, this is sort of a lost history. And again, it's obscure enough that probably most people haven't ever known it. But the primary architects of the Federal Reserve System as originally conceived were A, Carter Glass, the same Glass that we know from Glass-Steagall, and B, Paul Warburg, who was a German banker who immigrated to the US and who was very well familiar with and very experienced in the German Landesbanken system, essentially German development banking of the kind that led to the so-called German industrial miracle of the later 19th century. So Warburg on the one hand and Glass on the other were convinced that if a central bank was to be established in the US, it should be established along those sort of Landesbanken lines. And the idea then would be that all of the regional Federal Reserve banks would quote unquote discount commercial paper, basically monetize short-term debt instruments issued for, drumroll please, productive projects. And the word productive was actually a term of art included in the Fed mandate. And it was explicitly distinguished from speculative projects. In other words, and this blows people's minds, of course, because the Fed is the sort of king of speculation, or the god of speculators, and has been for at least 50 years now. But in its earliest days, the Fed was, quite explicitly anti-speculation and quite explicitly pro-production. And they were operating according to an idea, a sort of a flawed but largely true idea that some of you guys are probably familiar with, the so-called real bills doctrine. And the idea was that if you would only monetize so-called real bills, i.e. commercial paper that's associated with productive projects, not speculations or bets, then you would even have a largely self-regulating monetary system, in the sense that money supplies would expand in tandem with production, and then they would diminish in tandem with diminishing production. So you wouldn't tend ever to get a sort of a long-term imbalance between money supplies on the one hand and goods and services supplies on the other. That was the original version of the Fed. There was one flaw in what I call the strong real bills doctrine. I replace it in the book with something I call the weak real bills doctrine. The strong real bills doctrine was right that in order to get what I call money supply modulation right, you also have to get money supply allocation right. That basically good modulation requires good allocation. And they were right that that's necessary, but they were wrong in assuming that it was also sufficient. And the reason they were wrong in thinking that it was also sufficient was because A, some money is indeed exogenously sourced, most is endogenously generated, but some is exogenously sourced, especially if you're the United States right after the First World War and you're receiving all sorts of war debt repayments and all of the gold supplies of the world are coming toward you. Those are exogenous money supply shocks. And the real bills doctrine had nothing to say about those. And then they also, of course, overlooked what I call rehypothecation risk, which is, that's a bit technical. We can maybe set it to one side for the moment. But the Spread the Fed book that's coming out next essentially revises the real bills doctrine, replaces the strong one with the weak one, and then re-empowers the regional Federal Reserve banks to do basically local development lending, either directly by monetizing businesses' own debt paper that they issue in connection with productive products, or indirectly through commercial banks by agreeing to buy commercial paper off of their books when they buy it off of the books of the particular productive industries, or both, right? And I think I do refer in the book that we're talking about today to the Spread the Fed plan, but it's mainly in footnotes and all, but it's a kind of complementary project to this one. And so that's my sort of quote unquote answer in a sense, Radhika, just to put one more sort of detail on it. When we talk then about the Fed directly injecting money into people's digital wallet accounts, we would then be talking about the regional Federal Reserve banks doing that, not the Federal Reserve Board in Washington, D.C. So in other words, the plan itself would incorporate into its very structure that sort of local orientation. And also it would revive the focus on productive lending as explicitly distinguished from speculative lending.
But the existing regional Fed structure rather than
Yes.
a even more decentralized one.
I'm sort of agnostic about that in the sense that here's why. Even though we have 12 regional Federal Reserve banks, they have branches as well. People often don't know this either. These are sort of institutional details that are kind of dry and boring to most people, but of course, for our purposes, they're quite important. So the San Francisco Fed, for example, it's sort of anachronistic, first of all, that most of the Fed branches are actually located east of the Mississippi River, but they reflect the state of the US economy and the productive arrangements of the country back in 1913. And so in one sense, that should all be redone or revamped. In another sense, though, it's not really necessary because it's already happened anyway, sort of sub rosa. So back to the San Francisco Fed, which is one of the only ones west of the Mississippi. It has a branch office in Los Angeles, and the branch office in Los Angeles is much larger than the sort of home office in San Francisco. In other words, the Los Angeles branch of the San Francisco Fed is a tail that wags the dog in a sense, in that it's bigger than the San Francisco Fed itself. And the Dallas Fed, of course, has a branch office in Houston, which is probably rivals the Dallas Fed now in size as well because of the oil economy there. So in that sense, it's kind of easy enough to do the rearranging and the sort of more intensified localizing, even with existing authority. It's just that the people at the Fed don't really think about this very much, right? A little anecdote here might be sort of interesting. As you guys know, I used to work at the New York Fed, and the New York Fed, like the IMF, tends to have fairly low turnover when it comes to personnel apart from the very top. In other words, it's a good job, people love it, and they stay there. So a lot of my old colleagues at the New York Fed are still there, and they're wonderfully brilliant, bright, conscientious, socially thoughtful people. Not always the people at the top, but certainly they were. Now, as you guys know, during the COVID crisis in the US, the Fed innovated a number of interesting programs to try to help deal with the stresses. And one of them was the so-called Municipal Lending or Liquidity Facility, or the MLF. And the MLF was essentially designed to monetize local government debt, basically bonds that are issued by localities, because they were having to pick up all of the slack that the federal government wasn't dealing with during the pandemic. And the problem with the MLF was brilliant in conception because any town, towns all over Hawaii and all over the West, all over the East and the Midwest and so forth, were theoretically able to get Fed liquidity to handle their particular difficulties during the crisis. The problem was that the whole program was vested in the New York Fed, and it was to administer the whole bloody thing. And this included my colleagues at the New York Fed, who again are brilliant and conscientious people, but there are only 15 or 20 of them. And the thought that they could actually decide on what kind of liquidity to extend to Peoria, what kind of liquidity to extend to Fargo, what to extend to Honolulu, I mean, it was insane. And we did the same thing with the so-called Paycheck Protection Program and the other sort of business lending programs that the Fed also innovated for small businesses. I just call these the small business lending programs. There were 3 of them. They were all housed in the Boston Fed. I know a lot of those folk too, used to work with them. They're wonderful, brilliant, conscientious, and so forth, but they also are limited in number. There are 10 or 15 of them. How could you expect, right, a few people at the Boston Fed to do this? So the spread the Fed idea partly grew out of my experience with this, because what I did was I started advocating, like basically every couple of days I was writing something about this and in contact with my old Fed colleagues and saying, you guys got to spread these programs. You've got to spread them out of the New York Fed, out of the Boston Fed. Every regional Fed should be handling their particular regions with these programs. And then I was on the phone all the time with all sorts of municipal officials to try to put them in touch with New York Fed officials and Boston Fed officials and also their local regional Fed officials so that they could start advocating and pushing as a sort of lobbying effort for a sort of spreading of these programs. And I don't see why we can't do that now. You don't really need a crisis.
Good point. But this is again, sure, exactly. But this is again, you still haven't answered my 2 other questions about, the persuading banks to like it, even though they actually find this existential threat, which it is or would be, and they would not allow it to be realized. So you have to answer that, and also the question about capitalism. But this is exactly the sort of thing I mean, which will happen to this plan. You're talking about this municipal monetization of municipal loans and municipal bonds and so on. Great. But the fact is, we know that all the effort that was made through the Fed, through the Treasury, in every way, allegedly to protect people's incomes during COVID, was actually the aim of it was actually to keep up a level of demand for businesses, and overwhelmingly, and also to keep up payments, so that a lot of the money that it may have landed into somebody's account, some poor Joe or Jane's account, but more or less immediately, it barely stopped there for a breather before it went to some big private bank, etc., etc. So a lot of these efforts, I mean, while I do not at all disagree that your friends who are working there are very wonderful and conscientious, etc., and no matter how they justify this, the actual effect has been to reinforce and in fact strengthen even further the worst speculative predatory aspects of the system, so that during COVID, precisely as a result of the extraordinary Federal Reserve action, actually the structures of financial capitalism that plague the US economy have actually grown in size. So I just do want you to come back to those 2 more fundamental political questions, and then I'm sure Ben will have some others as well. So
yeah, a couple of quick things then. First off, I'm sorry not to have addressed the capitalism socialism question in your question cluster before, because that one also is of course quite important to me. 2 things. First, in the book, you might have noticed, I do reference centralization and socialization in one particular way. And that is, I say that it might still be possible that the productive sectors of the economy can continue to be sort of privately ordered, privately, decentralized and so forth. But that a prerequisite to that is that the financial system be centralized and socialized. That in other words, I myself I suspect that ultimately all of it will have to be socialized. But I think a fallback position is that even if we can, agree for the sake of argument or concede for the sake of argument that a privately ordered productive economy might be possible, one thing we can probably agree on, even lots of non-socialists can probably agree, that you still would have to socialize the investment sector or the financial sector, that that's a prerequisite to keeping the rest of the economy decentralized. And this is a variation when I sort of arrived at this idea or this thought independently, but then it struck me that maybe this is what Keynes had in mind when he talked about the socialization of investment and the euthanasia of the rentier in chapter 12 of the General Theory. And then I even speculated along these lines about 2 months ago, I published a piece, or 3 months ago, I published a piece called The Socialization of Investment. And it's a sort of one possible interpretation of what Keynes might have had in mind, because of course he was notoriously elliptical about this in the book itself. That takes me to the second response to you, Radhika, and that is, if we ask ourselves why would Keynes have been elliptical about that in the General Theory, I think it's because of the audience he was trying to reach, right? In fact, this is sort of a side note, but I have a strong suspicion that Keynes was much more influenced by Marx than he was willing to admit. And the reason might have been because he thought, well, Marx is kind of viewed as a sort of turgid German philosopher guy in the English-speaking world. And so people won't take him as seriously if he admits that he's, in some way rooted. It's amazing how many Keynesian terms of art, in fact, turn out to be in Capital, but nowhere else. I just discovered the other day, as Radhika knows, I'm rereading all of Capital cover to cover through all 3 volumes. And I'm now about a third of the way into volume 3. So I'm done with 1 and 2. In volume 2, of course, and in volume 1, the term credit money is used constantly or frequently. And I had always assumed that was Keynes's generalization of Wicksel's idea of bank money, because he first talks about it in the Treatise on Money, which is a kind of channeling of Wicksel for English-speaking readers. But credit money is all over Capital long before Wicksel says anything about bank money. Yesterday, maybe it was the day before yesterday, I came across literally the phrase, effective demand, for the first time outside of Keynes. And that's in Capital Volume 3 early on. And I think it's toward the end of Volume 2 as well. In any event, that's a side note. I think the reason Keynes would have been cagey about this, again, is I think it would have been a harder sell, right, for him to admit that there's a lot of Marx in what he's talking about and doing. And to some extent, that's what's going on with this book as well, right? Big part of my sort of academic project, even ever since I was a student, in fact, was I always used to think there, unfortunately, in the U.S., certain buzzwords sort of attain certain valences that lead people not even to think about what they mean or what they might mean or how they might be interpreted, right? So people hear the word communism, or if they read the phrase means of production, immediately little blinders go up. They think, oh, that's Marx, that's bad, that's evil, that's Stalin, that's, death camps, blah, blah, blah. And I thought, what if one were to systematically change some terms of art from the Marxian canon into sort of less already familiar terms that nevertheless mean the same thing. In other words, you change the connotation without changing the denotation. And so instead of means of production, say, productive assets, right? Instead of socialization of investment, maybe say centralization of financial management or something like that. And so that's another thing that's going on in the book. In other words, I hope nobody will think that the book is in any sense indifferent to or ignorant of, let alone hostile to, the Marxian take on things, because my own take on things is very Marxian, indeed quite orthodox Marxian. Final point about the political difficulties and will you ever get the buy-in from banks? My thought has always been, start by trying to reason with them. This is like something out of The Godfather. Right? I'll try to reason with them. Let's be reasonable. And if they are capable of and willing to reason with you in good faith, great. But if they're not, then you make them the offer they can't refuse. And I'm perfectly fine with that,
but
right?
Who's the actor here?
Well, I mean, it would have to be if there were another crash or crisis, and if it were profound enough that the Democratic Party was no longer able to undercut Bernie or a Bernie type and prevent him from becoming the nominee. So, because we came so close, right? If we could ever get to the point where you actually do have a president AOC, then I think it could happen, especially if, again, everything is in a shambles so that people are willing to say, screw the bankers. And the banks that are asking for the bailouts, we say, no bailouts, we're just going to nationalize you. All of you who work there can keep working there, but now you're now working for the US and not for Chase Manhattan, or I should say JP Morgan Chase and so forth. I mean, I hate to, this of course puts all of us in a sort of a difficult quandary in a sense, right? Because we sometimes find ourselves in the paradoxical position of having to hope for crisis and hence widespread suffering and probably premature deaths for lots of people in order to get the change that has to come. And one doesn't want to hope for that. But if that turns out to be the prerequisite to getting the real change to happen, well, I guess we just have to live with that and work with that.
Robert, you've mentioned a few times this idea that the banking system in the US is already semi-public.
Yeah.
And I agree in a sense, but I think we have the worst of both worlds right now, right? Because we have a system in which all of the risk is socialized and all of the profit, all the dividends are privatized. Yeah. So every time there's a crisis, the Federal Reserve creates all of these new acronyms for all of these liquidity mechanisms to provide loans to commercial banks. We saw this in 2023 with the collapse of Silicon Valley Bank and Signature Bank and First Republic Bank. And of course, the most famous example is 2008, the financial crisis. You mentioned at the beginning that basically the commercial banks are already kind of public, but I would say that's kind of right, but instead of being a public-private partnership, it's a private-public partnership. Private becomes first. And even the Federal Reserve itself, I mean, you have this idea of spreading out the Fed, which is an interesting idea. But as you know, the Fed is also not entirely a public institution. Of course, the Federal Reserve Board of Governors is a public institution created by Congress. The government appoints the members of the Board of Governors. But you've talked about the 12 Federal Reserve banks. Well, but they're actually really semi-private. And the commercial banks that are members of the Federal Reserve System, actually, they own stock in the local Federal Reserve Bank. So they're semi-private. Yeah. So if we were to try to have this kind of Trojan horse nationalization, or not even Trojan horse, just full-on nationalization, but go by nationalizing the financial system by going through the Fed and just cutting out the middlemen of the commercial banks, which obviously would never tolerate being nationalized. I mean, that's their worst nightmare.
Yeah.
I mean, could we use this existing structure of the Fed, or should we actually have a truly public Fed? I mean, people talk about, there's a lot of debate about the idea of central bank independence and whether or not the Fed and the Treasury are truly independent of each other. But I think that actually misses the forest for the trees. The reality is that the Fed is not even really public. It's people say it's semi-public, semi-private, but at the end of the day, it ends up falling, again, it becomes a private-public partnership as opposed to a public-private partnership.
Yeah, so that's, again, wonderful question, Ben, and thanks for raising it. There is, this is a place where a distinction between the personnel on the one hand and the policy or the law on the other hand can be helpful. It is actually the case, legally speaking, that not only is the Federal Reserve Board, the oversight body, entirely public, but in addition, each of the regional Federal Reserve banks has a 9-member board, Class A, Class B, and Class C directors. The Class A directors are always named by the board. The Class B directors are nominated by local bankers, and the Class C directors are nominated by non-banking institutions in the same regions. And the Federal Reserve Board has a veto power over those Class B and Class C nominations. And what that means is that then the Federal Reserve has, pardon the pun, in reserve, the capacity to completely command and control the whole system, legally speaking. It doesn't, however, because of bloody American politics, where we appoint to the Federal Reserve Board itself, and then, of course, we also appoint to the Federal Reserve regional banks lots of people who either are themselves bankers or are captured by bankers, maybe because they're former bankers. And so in that sense, the real problem when it comes to whether the Fed is to be considered public or public-private is in a certain sense the same problem as that accounts for the fact that the bankers are going to be a problem no matter what we do, and that is the politics, right? What that means in turn, I think, is we're brought back once again to, do we have to wait for a crisis, or does there have to be something, sort of profoundly existentially threatening so that the politics get to where we can actually, in effect, work a kind of coup? Another point in this connection is that I forgot to mention before, and that is, I do think it might be worth thinking from time to time about other possible constituencies, right? So it is true that the United States now, or at least in American political discourse, is once again becoming aware of the fact that there is something called production, that there is something called making stuff. There was no talk about production or making stuff in the 70s or 80s or 90s. People are sort of talking about it again. Industrial policy as a phrase, it's misused a lot, but at least it's part of the vocabulary again. You've got some Republicans, even like this Orrin Cass fellow with his little American Compass group, talking about how, it's been a raw deal for working class Americans, the whole globalization thing and so forth. And then, as I mentioned before, small businesses themselves chafe under the fact that they have to use the effing payments system, right? The electronic payment system that's administered by the Fed, but that is actually, whose contours are actually determined by private sector banking institutions. So it might well come to pass that we'll reach a point where things are effed up enough and the current trajectory has continued long enough that we can actually mobilize lots of sort of what Marx would have called the lumpenproletariat, and what other Americans might call the small business community, and also the productive sectors, which are beginning to flex their muscles in the U.S. now in a way that they hadn't for 50 years, to the point where the banks are sort of politically overmatched at long last, right? It could still happen, particularly if they are no longer necessary to the financing of the businesses, right? At the moment, there's a kind of a chicken and egg thing that we're faced with here, right? Because a lot of the businesses that would like to rebel against the banks are currently dependent on the banks, right, for their financing, and so they don't want to get on their bad side. But if you were actually to present them with an actual alternative, a public option, and paint it and sort of draw it up in detailed fashion for them, so they could sort of imagine themselves using it, so that then they can suddenly, for the first time, realize, actually, we're not dependent on those Wall Street banks, or at least we don't have to be. We could get to a point where we actually tip things politically to becoming an economy that's sort of production focused again and not finance focused. But again, as you guys know, certainly as Radhika knows, I'm sort of metabolically optimistic. So in other words, even if I have every reason not to be, I often will be, just as a physiological matter. And so I might be just kidding myself here. But it's tempting to think that it's at least not impossible, right? That you might get a gradual change in the political balance of power or forces, or what Stalin would have called the correlation of forces, to the point where the financial sector is indeed overmatched by the productive sectors. Then we have a whole new problem to deal with, and that's, of course, the original problem of Capital Volume 1, right? What about now these capitalists and their employees whom they exploit?
Yeah, and I mean, this is such an interesting conversation, and maybe we'll have to return to it at some point, but we need to wrap up right now. So I just want to make a couple of concluding comments, and then maybe allow both of you to do the same. I mean, first of all, Keynes and Marx, I think the most important difference between them is actually precisely about how to effect political change. I mean, both of them analyzed capitalism in a remarkably similar way, identified identified its problems in a remarkably similar way. But Marx had a conception of how political change happens. Keynes thought all you have to do is persuade the powers that be to change things, and that's not happening. Now, I don't think you are quite in that position, because on the one hand, I mean, you seem to have a slightly more realistic account saying that, you need a big disaster. But of course, I think there's going to be disasters aplenty in the United States in the coming decades. So you know what, your wish may come true. But the fact of the matter is, even when there is a disaster, unless there is a political force that is going to that understands what needs to be done, it's not going to happen. And that has to be something fairly radical, because otherwise what we'll get is a halfway measure, and capital will eventually take back control. Consider the disaster of the Great Depression. You got the famous banking legislation. The famous banking legislation actually made the United States financial system rather closer to what you are talking about, even without central bank digital currencies. And many people still look back to that era. So, but at the same time, of course, power remained in the hands of big capitalists, and they wormed their way back to the speculation that essentially they were engaging in the 1920s, and we now have it in spades, without even any kind of a gold anchor to the currency, so that we have money creation, which is completely, everybody thinks that money creation is in order to put the money into the pockets of ordinary people. No, money creation was to fill the black holes that were the balance sheets of the big financial institutions, both in 2008 and during 2020 and so on. So that's why I find that the politics of it, I mean, and a final point I'll make very quickly is that it seems to me that there is something oddly technological about this. I mean, we could have the kind of financial system that you're talking about in substance without needing central bank digital currencies. If that's the intention, then politically you can organize it without central bank digital currencies. So those are some of the points I wanted to make. I'll let Ben go and then quickly give you the final word, but we only have about 3 or 4 minutes. So.
Yeah, I mean, we're wrapping up here, so we don't really have a lot of time. But one I wanted to say, I'm glad you talked about Keynes's idea of the socialization of investment and euthanasia of the rentiers. I think this is an important part of Keynes that I think is actually intentionally often left out of a lot of mainstream economics classes. A lot of mainstream kind of Keynesian influenced economists often leave this part out and make Keynes only about someone who supported counter-cyclical spending, deficit spending in a time of crisis, and de-radicalizing the other parts of his analysis. But the other point I wanted to make is that on this issue of, in moments of crisis, the state always steps in to rescue private capital, but allows it to pocket all of its private profits. I'm reminded of a very interesting proposal that was made by Mark Blythe. I think it was in his book Angrynomics or another book, where he had this idea where the U.S. should have a sovereign wealth fund. I mean, even the UAE has a sovereign wealth fund. All these Gulf monarchies, it's not only socialist countries that have a sovereign wealth fund. And every time there's a crisis like this, instead of simply providing all of this liquidity, the U.S. government should take equity and say, fine, yeah, we will buy all of these assets. And they're obviously at a reduced price because everyone's trying to sell in this moment of crisis, in 2008 and 2020. And the Fed steps in with all this liquidity and very favorable conditions. They often buy these assets at face value and not market value, giving this great deal to all of these financial institutions that don't have to take a haircut, unlike normal people. And instead, they should say, no, we're going to take equity. We're going to take actual ownership in this. But of course, we would have to have a fundamental transformation in government that, again, would move from private-public partnership, where the private sector always benefits at the expense of the public, to an actual public program where the people benefit. But again, I mean, those are just some thoughts that I had. I know we're running out of time here.
Yeah, great thoughts. Just a couple of closing remarks. First off, just sort of a reminder. I know Radhika already knows this. This book and proposal is sort of one module, you might say, in a multi-module sort of vision that I've been sort of trying to elaborate. And that's why I've got so many books coming out, because each book is devoted to one particular module. Another one of the modules that kind of clips on very nicely to this one is addressing specifically what you just mentioned, Ben. If people are interested, if they were to Google the phrase Treasury growth dividends, and my name, Treasury growth, it's essentially a proposal and a design for a kind of U.S. sovereign wealth fund in which all of the citizens, from which all of the citizens receive dividends. A lot of the stuff that I've written ever since 2008 also is about how, indeed, the U.S. should take equity stakes in the entities that it rescues, rather than just making loans or buying bonds or whatever. And those should be full voting stock equity shares, indeed even controlling shares, maybe golden shares, where the U.S. actually gets control internally, doesn't have to exercise it all the time, but is prepared to. That takes me to a quick response to Radhika's final two remarks. We sort of did do something like that, as Radhika alluded to, during the Great Depression, and that was in the form of the Reconstruction Finance Corporation, or the RFC, which at the time was the largest banking institution in the entire world by far. And it was a public bank. It was, in other words, a U.S. government entity whose balance sheet dwarfed the balance sheets of all of the Wall Street banks combined at that particular point. And it is single-handedly responsible for rescuing the U.S. economy during that period, and then for financing the entire World War II mobilization. That, of course, raises the question, what happened? Well, of course, in 1947, the Cold War begins to happen in earnest. The Soviets explode their first atomic bomb, and then before long, they're doing hydrogen bombs. That, of course, enables the reactionaries in the U.S. Once again to get the upper hand in Congress, and of course, then they disband the RFC. They essentially sort of phase it out, although a lot of its subsidiaries are still with us, including Fannie Mae, including the Exim Bank, including the Small Business Administration, and so forth, that they too are partly captured. And I think what that highlights for us basically is that, ultimately there's never we're never done, so to speak, right? Even when Lenin finally succeeded in 1917, 1991 tells us, well, it's not done, because it's ultimately, of course, a global struggle. And if you can still have, global capital out there outside of your borders, always looking for a way in to sort of F everything up, even after you've actually made your domestic economy something closer to a utopia, then of course you're still not safe. And so insofar as we do, if we do, ultimately have crisis enough that we can actually fundamentally change everything, we still aren't going to be able to sort of rest on our laurels now and take a rest and say, okay, now we've reached, permanent utopia. There's always going to be insidious, egotistical, egocentric, capitalistic forces out there ready to sort of reemerge, it seems to me. And so, I guess that's a sort of a sober note to sort of add as a sort of caveat to all this sort of metabolic optimism I've been channeling over the last hour.
Well, thank you so much. I think we've had a really interesting conversation. I think shedding a lot of light on a subject that lots of people are wondering about. So I hope our audience will find all this discussion helpful, and who knows, we may even continue it. Meanwhile, thank you very much, Robert. Thanks very much, Ben. And we should bring this to a close for now. See you all, our audience, in a couple of weeks. Thanks, and bye-bye.
Thanks, guys. Much love. See you soon.